SPX and SPY Stock shot up about 1.35% today, and I wanted to kind of lay out some groundwork to say that seems a bit risky. There are some positives. There's probably some negatives. Treasury yields have been increasing. Let me break down all the charts that I'm looking at to show you that I'm not exactly on board with the move today. It could have been a quick, brief rally, but with U.S. Treasury yields continuing higher today, they're likely to start punctuating towards those levels we saw pre last week when there was some movement into safer assets. U.S. Treasury would brought down yields. Let's jump into the charts and I'll show you what I'm looking at. Before we jump in, if you look down below, you'll find links to in the description, you'll find links to my other two channels, plus links directly to my website, dhtayloranalysis.com, where you can sign up for the free email newsletter or written content on my analysis on stocks and the markets. The email is free. Every time I do a video, send it out. Let's keep you up to date. Here we're looking at the SPX and SPY Stock. We're actually looking at the SP 500 right here. Now, I did see throughout the day that the stock did kind of move up a little more, kind of remained about where it is right now for the finish. This was a pretty decent move higher. It was about 1.35%, which if you look at statistics, this is above average by a pretty decent amount. Average is going to be about 0.8% for a move for the day. So here you're looking at a much bigger picture of, and I think this is what the 2-hour bar chart, SPX, S&P 500. This particular chart, we're kind of still stuck here. I expect we'll probably move a little bit more sideways, but I believe that there is a lot of risk for downside movement. And I think what probably happened today was just relief buying, nothing more. That, okay, Israel, Gaza, or Hamas, that's probably going to remain contained. Don't know that the Republican Party has any shot whatsoever of putting a radical up there. There probably is going to have to be some kind of compromise. Eventually, something is going to happen, and it may be that a whole bunch of Republicans throw it in the face of a whole bunch of other Republicans, go to vote, and we have a Democratic Speaker of the House, which would be hilarious. Given that, there aren't really any geopolitical risks, but when you look at the Treasury yield, this is the 10-year Treasury yield. Now, something to keep in mind or to kind of look at, there's a little bump in the Treasury yield. The 2-year is above 5%. The 20-year is above 5%. One would assume the 10-year is as well. It is not. It's printing about 4.71%. I don't know any kind of rationale as to why that would be. It would seem to me that the 20-year would be slightly below, if not at, the same price or yield as the 10-year. Theoretically, you could sell the 20-year yield by buying 20-year treasuries and then buying or selling 10-year bonds, buying the yield, because the differential shouldn't be 0.3%. I'm pretty sure that there's a lot of really smart guys on the floor there. I don't know if they actually trade the floor in Chicago anymore. That they are probably eyeing that up as well and sitting there saying, arbitrage, there's something wrong here. Let's go in for the kill. It's the second deepest market on the planet outside of currencies. So I do expect that we'll probably see a continuation higher on the U.S. Treasury 10-year. It'll probably pair up with the 2 and the 20. That would push the 10-year back above 5. Here's something else to kind of keep in mind. The deficit on a percentage of the GDP. You're looking here, and if you kind of follow along, you see that big spike right in the middle. That was when the economy was awesome, not necessarily Clinton, but the economy sure was during the 1990s, late dot-com era moves all through, say, 99 into 2000. The economy was booming ridiculously. And because of that, the United States Treasury was bringing in money left and right. I don't think Clinton did a darn thing other than keep out of the way. I think the internet was just launching, and that's the way it happened. Since then, we've had a tough time getting kind of back up there, but Bush had a pretty decent run after dropping things back down. There was a recession, so you can't really blame that on Bush. He showed up as .com popped. Then he went to war twice. That didn't exactly help the deficit out on a percentage basis. He did see a little bit pop higher. Then he blew up the economy with the 2008 financial crisis. Obama walked into a mess, got it back up to a little less than what one would hope. Trump stepped in, got it up there a little better. Then COVID hit and everything sort of fell off a cliff. The economy is moderating and tax revenue is coming in. I don't know that Biden himself is actually really doing anything really other than letting the Federal Reserve fix its mess that it made. Regardless, how does this play out? The federal deficit, when the Treasury has to issue debt, you need a lot of buyers. As it turns out, we do have a lot of buyers, and there's more stepping in. So this really isn't a huge issue right now, but it is something you want to kind of keep an eye on. Because if the higher interest rates do contract the economy somewhat, this is going to get ugly again. Because the higher interest rates are actually attracting investors. Those investors are buying in on the U.S. Treasury markets, and they're also looking for secondary markets with, say, solid businesses and things like this. It's expanding the money supply. That's not what the Federal Reserve is trying to have happen right now. So the Federal Reserve is going to have to raise interest rates even more. That could choke out the economy somewhat. Then all of a sudden, the economies move back upward relative to GDP, debt to GDP ratio, then becomes skewed again. That could be a problem. Here, US dollar index, and as you can see, it's trending mostly higher because interest rates are so much better here than they are in other alternative investment countries. That becomes sort of the big picture that you really need to take a look at. I wouldn't be rushing into SPX or SPY stock myself for a long-term investment. I like to play SPX and SPY stock on a regular basis. 0 days to expiration, 0 DTE options are, I like playing those. I'll play overnight options and things like this. When I think things are getting out of line, I think the price movement today was out of line. I'm eyeing up puts going into the next couple days. We don't really have anything in the way of economic data this week that would skew the markets one way or another, but we do have a few things coming in the following 2 weeks, so that should be interesting. I'll keep you guys posted on SPX, SPY stock, what I think is going to happen next with those, bringing in all the factors that you should be considering if you are going to try and trade SPX or SPY stock. Make sure you follow those links down below. Sign up for the free email newsletter. Every time I send out the videos, you'll get an email. Follow my other channels. Like and follow this. We'll see you in the next video.